I'm Judy Shaw for NYSE Floor Talk. Joining me today is Samara Cohen. She is co-head of iShare Markets and Investments at BlackRock. And we also have Mina Nguyen. She is head of institutional strategy at Jane Street. And also Douglas Yones, who is our head of exchange traded products at the New York Stock Exchange. Welcome, everyone. It's great to see you. Now, a quick note to our viewers before we get started. This interview is for informational purposes only. The NYSE doesn't recommend any investments or investment strategies. All right. In 2020, we learned a lot about the resilience of the ETF market during extreme volatility. Samara, what's the main lesson learned from last year that you're carrying into 2021?
The main lesson that I'm carrying into 2021 is the importance of transparency. Transparency for markets, transparency for investors, and how fixed income ETFs specifically have delivered on that for investors. So let me give you a specific example of what I mean. There are two numbers, 2 and 9,000. If you look at our muni bond ETF, MUB, on one day in March, MUB traded 9,000 times on exchange, where its top 5 holdings, those bonds, each traded on average only 2. Now, of course, every time a trade happens on exchange, that's price formation, that's transparency to investors. And what ETPs provided both to investors to help them manage their fixed income exposures during turbulent times, and also as a feedback mechanism to bond markets to help bond markets price more algorithmically and trade more electronically. That's been how we've measured this value of transparency that exchange traded products have delivered to investors.
Okay, now Mina, can you tell us about the role of liquidity providers during heightened volatility? What was their experience last spring?
Yeah, I mean, I think this period really revealed to the markets how deep and diverse the mix of liquidity providers has become. We've talked a bit about this, but when the VIX is at 20, the expectation of liquidity is one thing. When it's at 85, which it was in March, that really causes investors to recalibrate their expectation of what is good liquidity and who can provide that liquidity. And so what you saw was a lot of varying providers stepping up, and then some having to step back because they weren't optimized for those conditions. Some are more optimized for speed, making markets in specific markets, and those are important tools in calm markets. But during March, you needed liquidity providers who could both have the capital to commit, but also comfortable holding and managing risk for longer periods. And so from our seat, we were triaging and thinking about how we effectively use our risk capital to step up and ensure orderly markets. And I think our peers stepped up as well. So the experience overall, I would say, all the necessary liquidity providers stepped up rather than step back during this period.
Doug, how did the recent equity market structure improvements hold up during the market swings in March 2020?
Judy, there have just been so many changes in the market infrastructure over the past 5 years. And, end of February, early March last year, we really got to test them all out. For the exchanges, for anyone not tracking, 3 of the top 5 traded days ever with respect to volume all happened in that short period of time. The exchanges we were processing over 329 billion messages on certain days. And the first time ever a market-wide circuit breaker occurred in the United States, the first time ever. And, when we look back on all that, what occurred? Everything that we had wanted to occur. We saw the markets pause. We saw liquidity immediately come back. We saw securities open back up the way we wanted to. And more importantly, as we're all discussing now, exchange traded products acted exactly the way we wanted them to be there, not just as fantastic investment tools that we talk about all year long, but also as a price discovery vehicle, a way for investors to immediately enter and access certain parts of the markets that they themselves weren't trading at that time. And so ETPs have stepped up, not just as terrific vehicles of choice for people making long-term investments, but also for institutional traders, for liquidity providers that are seeking liquidity during times of market stress. And we've really seen that play out through the pandemic.
Okay, now I have a question for everyone. Would love to hear from all of you. In a sentence or two, give us a prediction for how the ETF market will evolve over the next 5 years. Samara, let's start with you.
So Judy, equity ETFs are about 10% of global equity markets. Bond ETFs are about 1% of global bond markets. So my prediction for the next 5 years is absolutely that bond ETFs will expand more quickly than they have so far to cover a larger piece of the bond market, and that will happen across sub-asset classes. So it's a story well beyond corporate credit, in treasuries, in munis, in mortgages, and also the integration of sustainable strategies. So that's my 5-year prediction.
Okay, and how about you, Mina?
Judy, I just think similar to Samara, it's going to be much bigger in terms of volumes traded, and the products that will emerge will be more targeted, giving institutional investors and retail investors more optionality. And in the end, I think it's going to be used by a much broader community of people, and we're going to probably see that in the next 5 years, if not sooner.
All right, and finally, Doug, what's your prediction?
So the next 5 years will absolutely be faster growing and with a larger amount of assets under management coming into the industry than the previous 5 years, without a doubt. There's so much growth. There's so much opportunity for everyone. Last year alone, 27 new asset managers came to the ETF space. I think we'll beat that number this year. There's just so much greenfield. There's so much opportunity for asset managers to step in and offer a better investment vehicle to their clients, whether it be a lower cost vehicle, better tax strategies, a global distribution footprint, or access to asset classes previously untapped. So I think there's so much opportunity in the index space and the active space that the growth we'll see over the next 5 years will be pretty tremendous.
Okay, it's been great to talk with you all. Thanks for joining me on NYSE Floor Talk.
Great, thank you.
Thanks, Judy.